Wage growth nears three-year lows in June as labor market enters, quote, a different regime. And this is a bit of a mixed bag. Wages not growing isn't great since inflation remains high, but if wage growth slows, then the chances for things like rate cuts does get much higher. So there could be some benefits to this, even though the obvious downside is that people are not earning as much money. As you can see here from the article, pay increases for American workers have continued to fall from highs reached during the post-pandemic reopening. And it's true for folks keeping the same job as it is for those trying to find a new gig. According to new data from ADP released Wednesday, annual wage increases for workers who stayed in their same job increased at the slowest rate in nearly 3 years in June. For job changers, annual wage increases slid for the third straight month. We're in a different regime than we've been in the past, where that job stayer growth was either flat or even rising, ADP chief economist Nella Richardson said during a call with reporters on Wednesday. The question before us is, just how low is it going to get? The idea that job stayer growth would go back to pre-pandemic levels is beginning to be challenged. So basically, both for job stayers and job changers, which is people who stay at their job for long periods of time, or people who change their job regularly in order to try and either get better positions, better benefits, or higher wages, their wage growth are both going down, and you can actually see the specific insights from ADP's report. Pay gains for job stayers slowed in June. Year-over-year pay gains for job stayers were 4.9% in June, the slowest pace growth of any year since 2021 August. Pay gains for job changers are slowed to 7.7%, and then this is the median June pay level, and this is the amount that it went up. And as you can see here, this is median pay change, so this is not total pay going down, this is how much more you're paid each year going down. So wages on average are still going up, but the percentage that they're going up is actually decreasing. And you can see here that it was pretty low in January of 2021. And then as the Great Resignation happened and people were able to switch jobs at will and be able to find new employment pretty easily. And there was that whole issue where companies physically couldn't keep enough workers because they were able to go somewhere else for even higher wages, and inflation went crazy as companies tried to hold on to profits to keep their stock price up. That is all happening in this area here, where job changer growth, people who left their job to find a better paying job, went up by 16.4%. But as you can see, it has been dipping for quite a bit now. And another interesting thing to note is that people who change their job tend to make like 50% more than people who stay in their job. Even now, if you stay in your job, your salary goes up by an average of 4.9%. But if you change your job, your salary goes up by an average of 7.7%. That is really interesting. If you want to change your life and money would be the thing that change your life, then statistically the best thing you can do is leave and find another job that will pay you more money. Now, the reason that wage growth is slowing is because it's becoming harder to actually find another job. And the harder it is to find a job, the less companies are willing to pay in order to get you because you have fewer options. If you have the option of working at, say, 10 different factories, and all 10 of those factories desperately need you in order to meet their production quotas, then they're going to compete against each other, raising the salary until they can finally get you, because they stand to lose a lot of money if they don't have you working their lines in order to meet their production quota. Whereas if there are only 2 factories that need you, then they're going to bid up the salary a little bit, but less. And then if there's only 1 factory that needs you, you can imagine that they'll offer a certain amount, but then you don't have any other options, so that factory knows you have to take the job from them and is probably not going to offer you any more money. And we know that there are fewer job openings because of this. Job openings fall to the lowest level since February of 2021. Job openings fell in April to their lowest level since February 2021 as the labor market shows further signs of cooling off from the hiring boom that followed the US economy reopening after the pandemic. And this was that hiring boom that led to salaries going crazy. New data from the Bureau of Labor Statistics released Tuesday showed that there were 8.06 million job openings at the end of April, a decrease from the 8.35 million job openings in March. March's figure was revised lower from the 8.48 million jobs initially reported. Economists surveyed by Bloomberg had expected the report to show 8.35 million openings in April. So fewer job openings means employers have more power since the employees have fewer options as to where to go. I am able to treat my employees worse if I know they don't have any other options, whereas I might treat them better and pay them more and give them more benefits if I know that at the drop of a hat, they could leave me for a competitor. And before we get any further, if you like this kind of deep dive into business and finance news, I post 3 to 5 times a week, and I'd love a subscription and to see you around here on some other videos. Now, when a report like this comes out, there's always 2 reactions. One is people saying that wage growth slowing is bad because inflation is still high, so people will have relatively less money to spend to stimulate the economy, and also their quality of life and standard of living will go down because inflation is more closely outpacing their wage growth. And the second reaction is people saying that the Fed has to now cut interest rates because the data is showing the policies are having the intended effect. Therefore, in September and then possibly again before the end of the year, we have to have rate cuts. So to the people with the first reaction, yes, people have relatively less money to spend. But the good side of that is that a lot of prices are either staying flat or going down. As you can see from the May Consumer Price Index report, which is the most recent that we have, a lot of these in May are either flat, 0.10, and then 0.4 is a little higher with the food away, but then a lot of these are actually negative. Energy prices have come down, gasoline prices have come down, electric prices have come down, utility services prices have come down, apparel prices have come down. You can see that even as this wage growth is slowing here, the consumer price index is showing that things are either staying the same in price or a lot of them seem to be getting cheaper. Now, the big exceptions here, as you can see, obviously transportation services is up in the last 12 months is up 10.5%, so like the cost of cars and so on, and then shelter is up by 5.4%, and that's obviously not great, but there are some things you can do about it. For example, transportation costs are up. It's easier just to buy a car that either you can pay for in all cash so you don't have to take out a payment, that's the best option, or if you absolutely can't afford it, to take out the smallest loan possible so that you are not breaking your budget trying to pay for a new car that you can't reasonably afford. And for shelter, you do have fewer options because if all the prices in all the apartments go up or all the prices of all the houses go up, then you are just unable to afford shelter reasonably. But the good thing is having one difficult line item in your budget is possible. If the price of everything goes up, all your food, housing, transportation, medical care, if everything is going up, then it's impossible to budget. But if only one thing is going up because the rest is either coming down or you're reasonably able to control it, then it's not good, but it is a far better situation. Now, for the second group of people who are saying that the Fed will now have to cut interest rates because of the policies that they have been implementing have been having the desired effect, whether or not effect is good or bad is up for debate, but they are having the effect that they were intended to have, there's actually good news for those people as well. As you can see here, the odds of the Fed cutting the rates seem to have gone up. After the June jobs report, markets were pricing in 78% odds of a rate cut by September 18th in the Fed meeting, up from 73% according to CME Group's FedWatch page. Markets now see a 75% chance of at least 2 quarter-point Fed rate cuts by the year's final meeting on December 18th, up from 70%. Odds that the second rate cut will come at the November 7th Fed meeting rose to 37% from 31%. Markets also now see higher odds of 75 basis point rate cuts this year, 29%, than just a single quarter point cut, 25%. Fed Chair Jerome Powell said this week that solid growth won't prevent Fed rate cuts, but policymakers will pivot faster if hiring weakens. Ian Shepherdson, chief economist at Pantheon Macroeconomics, wrote that he expects payroll gains to slip below 100,000 per month by the summer, and payroll gains is people being added to payroll, so basically the amount of people hired. This could lead the Fed to cut by as much as 125 basis points this year, Shepherdson believes. Now, I am not at all sold on this 125 basis points. I think that's just him trying to get a headline or be recognized in some way, and there's a chance he's right, and he can say if he's right, and then if he's wrong, then nobody really cares. So I genuinely do not believe that 125 basis point cut will happen this year, but I think there's a really good chance of a 50 point basis cut and possibly up to a 75% one if we see really good data from the next quarter of inflation. So are wages growing more slowly? And the answer is yes, but wages as a raw number is essentially meaningless. In this specific case, it is beating out inflation, just barely, but it is beating out inflation, and many CPI categories are actually dropping in price, and this increases the chance of the Fed cutting interest rates in the coming months and in the coming meetings and making housing more affordable. So It is not a great thing that wage growth is slowing down because people have money, but it is a good impact and effect that it has on potential rate cuts for more cheap housing, and also on inflation over the fact that people are going to be more able to afford to pay for things that they need, as you can see in this report. Thanks for watching.